Hi, in this video I'm going to show you how to compute the alpha of a strategy once you have exported all your data into Excel. So I'm beginning with the spreadsheet that we had at the end of the previous video, and if you haven't seen that video yet, you can skim my channel for the video on how to export data from Equities Lab to Excel. But anyway, this is what the exported data looks like. We have the raw backtest data over here, and then we had computed the daily returns. Okay, and the average daily return for the screener was 8.5 basis points, and for the S&P it was 4 basis points. So the easiest way to get the alpha is simply to use what's called the intercept command. And as you type that in, it's going to say, tell me what your known y's are and what your known x's are. The known y's are going to be the screener returns. Now technically you're going to want to subtract the risk-free rate from these returns. Given the risk-free rate doesn't vary that much, it's not the biggest of deals not to do that. A bigger deal is actually that we're using daily returns, and I'll come to that in a minute. So once you've entered your known y's, I've just selected that whole row, you will enter your known x's, which are going to be the market returns, and then you'll just hit enter, and there you have it. The daily alpha is this minuscule 7 basis points. Okay, okay, that's, you know, part of the issue here is that it's a little bit difficult to interpret that number. The other issue is that this doesn't really jive well with the difference between these two numbers. Now, if you just go back to the graph that we had for the backtest, we can see that this is likely to have a positive beta. When the market went down, this went down. The market went up, this kind of went up. Now there might be some exceptions here, but it looks like it should have a positive beta. And you know, if it has a beta that's anything like 1, what we should expect is that the alpha should be the difference between these two numbers. And the beta, actually we can compute the beta too, speaking of the beta. So you'll compute the slope, and again the known y's, the known x. Okay, so the daily return beta is 0.3. Okay. Now this again is one of the issues with using daily returns here. When you use daily returns, you end up with a lot of noise in the return series. A much better thing to do is to actually use these data here and compute monthly returns. So you'll take this 102.156 divided by the 100, and you'll get a monthly return of 2.156. Same thing here, and so on and so forth, and just compress that 10 years of data into about 120 months of returns, and then use those monthly returns to compute your alphas and betas. Okay, so I think that's a much better way to do things. I'll probably show you how to do that in a separate video, but for now, here's that one simple way to compute alphas. Another way you can compute alphas is you can use the regression command. If you have data analysis, you can scroll down to regression. It's going to say input your Y range. So again, it's exactly the same thing we had before. Input your X range, right? And just hit OK. And you'll see the alpha is over there. That's the intercept. The beta is over there. That's the exactly what we found in the previous tab. The additional stuff that you have here are the standard errors and the t-stats. Now these are an indication of how statistically reliable our alpha and beta estimates are. In general, t-stats above 2 suggest statistical significance. What that means is that it is unlikely that these results occurred by chance. And in this case, both of our intercepts and our slope are statistically significant, saying that it's unlikely that we're seeing these positive numbers by chance. And that gives us a little bit more comfort with these numbers. So anyway, that was another way to compute the alpha and the beta of the strategy.